Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today I want to talk about the rather alarming state of fiscal and monetary policy and where I see the road potentially leading us to. We've heard a lot about how the Federal Reserve has been printing lots of money. I've definitely been talking about it on this channel. You've probably heard it elsewhere as well. The US government is spending a ton of money to try and stimulate the economy through this terrible time that we're in, and they're pulling all sorts of debt out, and the Federal Reserve is buying that debt and is printing money to pay for that debt, and that's where we get our famous meme. The Fed has also been expanding its influence through other means by lending tons of new printed money to different institutions to then buy bonds on its behalf that it otherwise wouldn't be able to buy, like actual bonds of private corporations, because the Fed is technically only allowed to actually directly buy US treasuries on the open market. But what they're doing as well is they're lending money to other companies, and those companies are then buying bonds on the Fed's behalf. So it's a workaround for as to what the Fed's actually allowed to do. That's beside the point of this video, but the point is that the Fed is printing tons of new money to pay for all sorts of things to try and keep the markets liquid and keep them propped up to where they've been for the last few years or really few decades. Because when we take a step back and look at what has happened over the last 40 or so years, you really start to see a rather dangerous trend. This is the federal funds rate. This is the rate that you often hear about the Fed changing. This is the rate that basically banks can lend to each other at, and the lower this is, the more cheaply money can be lent, and therefore interest rates for things like mortgages and cars and whatever, all that stuff becomes much cheaper too. And that goes for government debt as well. When debt is cheap, we'd expect people to take more debt out, and therefore there'd be more spending, and that goes for the corporate level too, and really the government level if you think about it, since the idea is that the rate is so cheap, so it's not as much of a penalty to take out new debt, and a government can decide to issue new bonds at a very super low rate, so it's not as much of a cost to it to actually run deficits and all that stuff as it tries to ideally stimulate the economy. So this graph goes from 1971 until now. So in 1971, the reason I picked this year is this is when the US left the gold standard. That was when the US had its currency backed by gold, but that eventually was removed by President Nixon because it would be much easier for the government to now manipulate currency and actually print a lot more of it to finance all sorts of government activities. It unlocked brand new flexibility for the government to actually spend lots of money on things that it otherwise couldn't really afford, and rather than actually issuing new debt that it had to sell to people, the Fed could buy things more easily, for example. Because when the currency was pegged to gold, it was a lot harder to manipulate. It could still be manipulated, no doubt. You could change the price of gold among other things, but it was much harder to do what the Fed does now, which is print tons and tons of money immediately whenever it wants to, or really just type in digits on a computer, and then all of a sudden they have trillions of dollars of new money. But printing money, or quantitative easing as it's called, is a relatively new phenomenon. It's not that we've never seen it before, but for the US, it generally hasn't been that big of a deal until these last 40 years. Other countries like Weimar Germany, Zimbabwe, Venezuela, they've had their episodes with hyperinflation by massive government money printing. We're not at that level yet, but maybe we will, and I'll get to that in a second. But one of the big tools that the Fed uses is it manipulates this interest rate. But look at where it was in 1980. So in the 70s, we had stagflation. This is where prices skyrocketed because of a variety of things, partly government printing, partly supply shocks to things like oil, but basically prices rose dramatically. Coming into the 80s, Paul Volcker became the new Fed chair, and he wanted to combat inflation, so he jacked interest rates up, and that's where you see them here from 15 to 20% at the beginning of 1980. But look what happens after 1980. You see the government continuously slash interest rates along this downward trend until we get to today. It has been almost exclusively in the negative. We see interest rates going lower and lower and lower, and yes, we see some spikes up for a usually pretty short period of time, relatively speaking, and then it's followed by a rapid decrease downwards as we get closer and closer to zero, which we're at right now. Because what happens when the government raises rates? Well, you chill new economic activity because people won't take out as much debt. And when you do that, you can't keep up the current system that's already coked up on a ton of debt. So what do? The Fed just decides, well, more debt can be the answer to this debt, so they lower interest rates, because that's kind of the only decision they have if they don't want to blow up the entire system. And when you take a look at the S&P 500 from 1980 until today, it follows this graph very closely. They are inversely correlated totally, in that as interest rates lower, you see the S&P 500 or the stock market going up and up and up. This is mostly regardless of what the economy is doing, especially as we can tell now, the economy is absolutely in the toilet right now, yet the S&P 500 is breaking all-time highs day after day. And this is not a coincidence when the Federal Reserve has recently slashed rates to zero just within the last few months. So debt is super cheap, so we're seeing more and more people and corporations taking out tons of debt to pay for their operations, pay for their lives, or even pay for their new day trading habits. So the system is entirely running on very cheap debt. So when you take away cheap debt, you're going to get a collapse, and you're going to see this bubble that's been inflated over these last 40 years start to deflate. And this is where we get to a fork in the road. The government has two choices right now. It can either deflate the bubble that it has created, or it can blow it up and get into hyperinflation territory. So as I mentioned, this bubble has slowly been inflated over the last 40 years as debt has become artificially cheap, super cheap actually, to where we're at all-time lows in interest rates. And if the Fed raises interest rates, or if the government stops spending and stops relying on the Fed to buy its new debt that it keeps issuing, then all of a sudden we'd have nothing holding up this super amazing financial market right now. You'd have the bubble deflating and market values would decrease. So it would just create the exact opposite of what the Fed is trying to do with its general policy goals, which is keeping markets liquid and really just keeping them propped up at whatever price point they think is appropriate, which to them seems to be that stocks only go up, so there's no ceiling for as to how high stocks should go. If we get to that point where they raise rates back up to where they probably naturally should be, and the government stops spending, you'd have a huge economic contraction because nothing would be propping up the economy or the financial markets anymore, so you'd kind of have nothing left. So we'd go through this terribly painful situation where prices would probably decrease and get back to where they probably should be. The US would force itself to actually start producing things again rather than relying on debt to go and buy it from other countries like we have been for the last 20 or so years, 30 even, when things started opening up with China, also in the 80s. Not that buying from other countries like China is a bad thing in itself. The problem is how we're buying this stuff. We're buying it with money that we're pulling from debt and then printing into existence rather than actually producing something of value and then trading it. So anyways, that's the first fork in the road. You can turn towards the side that is deflation and reducing government spending and getting things balanced and raising interest rates and going through this really painful economic period to try and deflate the bubble. What's the alternative? The alternative that I think is more likely given the amount of debt that basically everyone has. That alternative is very high or even hyperinflation. This is where the government will keep spending tons of money that it doesn't have at an even higher level than it already is because it has no choice as less and less people are working and more people are requiring this unemployment income or UBI or whatever it happens to be. These programs are going to get bigger and bigger and bigger, and the US is going to produce less and less. So the only way to actually get money, because we're not selling any real product or even services in this case, you're going to need to print that money into existence. With all the printing that would come into existence and the lack of actual production, you would see prices of goods rise dramatically. Each dollar would become worth less and less because new ones are being printed every single day, or I should say again, typed into existence on a computer, and the value of each individual dollar would become worth much less. So a dollar could not buy you as much as it could before because prices would be rising. But on the debt side, your debt is becoming worth less and less too as your asset prices are increasing artificially through inflation. And I say prices, not value, because the value of something shouldn't really change much in the short term, but in the short term, prices could change a lot through things like inflation and money printing. So you see this massive price growth across the board in asset prices and food prices and good prices, whatever it happens to be, if we get to a hyperinflation zone. But this theoretically would wipe away the current debts that we have at the expense of basically all poor people who don't have assets and don't have any debt to actually get rid of, as their cost of living would skyrocket and their wages might not keep up with that. So you'd have a terrible economic situation in that fork in the road as well. Which one will the government choose? Since we're at a point where one of them needs to happen. They could do this over many, many years. It might be a slow deflation, or it might be a steady inflation, as it kind of has been for a while. But the point is, we're at this point where we can't really keep doing what we've been doing, which is slashing interest rates every single year and making things artificially cheaper by having all this super easily accessible and very cheap debt. That just is not going to be an option at some point. I can't say which one for sure is going to happen. No one can, but I would lean on the side of there being hyperinflation, and those people with assets will be in a better place as opposed to those who don't, because their asset prices will rise and their debt values will decrease. So you would be in a slightly better position than someone who doesn't have assets and just sees their savings wiped out because cash becomes worthless. The deflation option is probably the best case scenario if the government were to actually balance its budget and actually basically impose austerity, as terrible as it is. But something needs to be done to get us out of this bubble that we're in, because it's been created by all of this artificially cheap debt. I know this is a bit of a downer video, but I wanted to expose you guys to this data and my thoughts on it, because it just seems like this is overwhelmingly becoming a bigger and bigger problem, and I don't know what is going to happen. I think it's important that we all come to our own reasonable conclusions about what to do, but at least be prepared for something pretty poor to happen, because I don't see a very good or easy way out of this situation that we're in. And this is completely aside from the fact that we still have a pandemic and people are suffering because of that on its own. So it's just another thing on top of this layer of so much fun that we've had in 2020, but I did want to show it and bring this to your attention. I definitely would love to get your guys' opinion in the comments below and see what you guys have come across, what you think is going to happen. Maybe there's some new data that I haven't seen that maybe you want to share with the rest of us. I'd appreciate that. So definitely leave comments below if you have any thoughts on that. But otherwise, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. I cover a variety of topics as they relate to the financial markets, real estate, investing, pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to subscribe so you don't miss any new updates. And just a reminder, my new book just released last week, The One Property Retirement. You can pick up a copy in the Amazon link below. I would definitely appreciate that. And if you do end up buying the book, please leave a review on Amazon, as that would help me out a lot. And if you want some free money before we head into either direction, whether it be good or bad, definitely check out the links in the description for Webull and Robinhood, and you can get some free stocks there if you don't have accounts with them already. But until next time, take care.